Figma. Okay, it's the name that's basically become synonymous with collaborative design, a real powerhouse. But here's the big question we're tackling today. Is it truly unbreachable in its market, like a creative fortress built to last? Or is its recent spectacular IPO and all that buzz actually the high watermark? Before new disruptions, maybe even AI start chipping away at that dominance. That's really the core mystery we're digging into, because understanding Figma goes way beyond just the flashy brand. Welcome back to the Deep Dive. This is where we take a whole stack of sources articles, research, our own notes, and pull out the most important nuggets of knowledge and insight, specifically for you. Today we're doing a deep dive into Figma Inc. They trade on the NYSE, ticker symbol FIG. Just so you know, all the data and analysis we'll be talking about is as of September 2, 2025. And for context, the last closing share price we'll be using is $70.28 from back on August 29, 2025. Our mission today, it's pretty simple and give you a shortcut to being genuinely well-informed about Figma. We're talking its business, management, financials, market position, who owns it, and yeah, those crucial risks.
We want to help you connect the dots. So whether you're just curious about the tech industry, maybe you're a designer using Figma every single day, or perhaps you're analyzing its investment potential, this deep dive has the crucial insights you need. We've got quite a bit to cover, so we're breaking it down into two main parts. First up, we'll explore the fundamentals. That means Chapter 1. Business analysis, then Chapter 2. Management evaluation, and finishing Part 1 with Chapter 3, financial analysis. Then after a quick breather, we'll jump right back in with Chapter 4. Market sentiment, Chapter 5, ownership structure, Chapter 6, risk assessment, and we'll wrap it all up in Chapter 7. Conclusion. All right, let's get started. Time to really unpack Chapter 1, business analysis. So what makes Figma's core business tick? How does this company actually make its money?
Well, what's really fascinating about Figma is its incredibly shrewd freemium software as a service model. SaaS, it's really a textbook example of product-led growth, or PLG. Their strategy is kind of genius in its simplicity. Basically make the product so accessible and just so good that its quality naturally drives viral adoption. They offer a free starter tier, right? And that acts as a really low friction entry point. It just removes any barrier to trying it out. Think about it. Maybe a designer starts a personal project, then they share a link with a colleague, and suddenly their entire team, product managers, engineers, marketers, they're all exposed to Figma's collaborative power.
Right, so it's almost like this digital Trojan horse, isn't it? You get a free taste, realize how powerful it is, and bam, your whole team's suddenly interested or even using it. I remember trying to collaborate on design before Figma. It felt like pulling teeth just getting everyone on the same page, let alone the right version.
Exactly. It just fundamentally changed the whole game. Dylan Field, the founder, he famously said he built Figma because he hated the existing tools. And that kind of, frustration-driven innovation, it often leads to the most impactful products. And the numbers really back this up. Their S1 filing, when they went public, revealed that something like 70% of their enterprise-level contracts actually started with individuals who were on a paid professional plan first.
Wow, 70%.
Yeah, it shows how effectively that initial personal adoption translates into these massive corporate deals. So revenue primarily comes from those paid subscriptions. It's sold per seat, per month, and they have tiered pricing, professional, organization, and enterprise plans.
And I noticed they've even brought in something called persona-based seats.
Mm-hmm.
What's the thinking there? It sounds like they're really being strategic about where the value lies.
Oh yeah, that move to dev seats for engineers and content seats for marketers, that's incredibly insightful. It shows Figma gets that the value isn't just in creating the design itself, it's in the entire product lifecycle. So from ideation all the way to the engineering handoff. By catering to these different personas, they're not just expanding their user base, they're actually tapping into completely new departmental budgets within the same client company.
Ah, interesting.
Yeah, they're effectively widening their addressable market from inside the organization, maximizing revenue from, every corner of the product team.
That's a really powerful way to land and expand, making Figma almost indispensable to everyone involved in creating the digital product, not just designers. Okay, so beyond this clever business model, what are Figma's key products, and how are they expanding that platform to keep the momentum going?
Right, so Figma isn't just one tool anymore. It's rapidly becoming this integrated kind of end-to-end platform for product development. They're core products. You've got Figma Design, that's the flagship browser-based multiplayer UI/UX tool, user interface, user experience. Then there's FigJam, that's their online collaborative whiteboard. It really expands their reach beyond designers, used for brainstorming, diagramming. It competes directly with tools like Miro. And finally, Dev Mode. That's a specialized feature within Figma Design that really bridges the gap between design and engineering. It provides code snippets, specifications, just streamlines the whole handoff process. But what's also really notable is their aggressive expansion lately. They unveiled a bunch of new products at their 2025 Config conference, things like Figma Slides, Figma Sites for publishing websites directly, and a whole suite of AI-powered tools, Figma Make, Buzz, Draw.
Wow.
It really shows their ambition to be the central hub for, well, all creative and product development work.
Okay, so they're definitely not content just being the design tool. They're aiming for the whole workflow.
Which brings me to my next question. This is where it gets really interesting. How dominant is Figma in its market, and what's the primary value proposition that's making it so sticky?
Figma holds a genuinely dominant position. They report over 13 million monthly active users. And get this,
Yeah.
penetration in a staggering 95% of Fortune 500 companies.
95%.
Yeah, this widespread adoption has really cemented Figma as, the de facto tool in the space. But what's maybe even more fascinating is how their user base has evolved. An estimated 2/3 of weekly active users are now actually non-designers.
Really? Like who product managers, engineers, marketers. This shows it isn't just a design tool anymore. It's really transformed into this broad collaboration platform, their primary value proposition. It kind of boils down to making design truly collaborative, accessible, and efficient. It fundamentally changed digital design by moving it from those fragmented desktop tools, remember emailing files back and forth, to a live, browser-based, multiplayer environment. Before Figma, you had version control nightmares, slow feedback loops, just chaos. Now, with a single source of truth in the cloud, everyone can view, comment, even edit in real time. It just accelerates decisions and, frankly, democratizes the entire design process.
That sounds almost too good to be true. In the tech world, de facto standard can sometimes quickly become legacy if you're not careful. Are there any genuine threats to this dominance, or are they truly building unbreachable barriers against the competition?
That's a critical question, absolutely. The competitive landscape is definitely dynamic. Adobe, for instance, after that failed $20 billion acquisition attempt. They're now what you'd call a ruthless competitor, intensely focused on pushing their own collaborative tools.
Right, they must be motivated.
Highly motivated. Figma has largely displaced older incumbents like Sketch and InVision, but you've got adjacent challengers too. Miro for the whiteboard space with FigJam and Canva, pushing into broader content creation tools. They're both growing fast. And then there are new threats emerging, things like no-code tools, Webflow, Framer, and maybe even more significantly, these new AI-native design tools that can generate interfaces just from text prompts. That could fundamentally change how design gets done.
AI. Yeah, that feels like a potential game changer everywhere.
It really does. However, Figma has built significant barriers to entry. The underlying tech for their real-time collaboration. It's incredibly complex. It's built on these advanced concepts like operational transforms and CRDTs. You can think of them as really sophisticated algorithms that make sure everyone sees the same correct version of a document, even when multiple people are editing at the exact same time without causing conflicts.
So that's basically the secret sauce, the thing that makes the multiplayer experience so seamless and reliable, preventing those awful version control issues.
Precisely. That's a massive technical moat, and it's incredibly difficult and expensive to replicate well. Beyond that tech, there are strong network effects. The more people in an organization use Figma, the more valuable it becomes to everyone else there. And crucially, high switching costs. Once a company builds its entire workflow, its design systems, everything on Figma, migrating away becomes prohibitively expensive and disruptive. It's a huge pain.
Okay, that makes sense. The tech, the network effect, the switching costs.
Yeah, and if we connect this to the bigger picture, their competitive advantages also include really strong brand recognition. Figma is almost synonymous with collaborative design now. That's boosted by over 200 Friends of Figma community chapters globally. They also have cost advantages from that product-led growth model we talked about. It means low customer acquisition costs, which lets them have those exceptionally high SaaS gross margins. That, in turn, fuels aggressive reinvestment. And finally, there's a vast ecosystem of over 10,000 third-party plugins. That further solidifies their moat, making Figma feel more like a platform, not just a single product.
Phenomenal insights into the business side. Now that we've really dug into the product and the business model, let's pivot from the tech to the people behind it. Let's dive into Chapter 2. Management evaluation. Who's leading Figma and what's their story?
Figma is famously founder-led by Dylan Field, who's the CEO, and his track record really shows this patient, very product-focused and kind of community-centric leadership style. He was a Thiel Fellow, actually dropped out of Brown University to pursue Figma, and he spent years building the core product almost under the radar, just making sure the user experience was perfect before they really launched big. A really unique aspect of his leadership is his deep commitment to the user community. I mean, he's known to travel globally just to attend user meetups.
That's pretty cool. Shows dedication.
It really does. And maybe the biggest test of his leadership came with that proposed Adobe acquisition. He navigated all that intense scrutiny with what people described as a grounded and transparent response. Then, when the deal collapsed, he apparently didn't flinch. He turned it into this galvanizing moment for the company by immediately unveiling 4 major new products at their Config conference. It really signaled a renewed, aggressive innovation roadmap.
Wow. Talk about turning a potential negative into a positive.
Exactly. It showed incredible resilience and vision, I think.
That's certainly a testament to his leadership. But what about the company culture itself? And maybe more importantly, for anyone looking at this as an investment, how is capital being allocated under his guidance?
While their internal culture seems to be a significant strength, Figma is actually a certified great place to work. We're talking 96% of U.S. employees and 94% of U.K. employees agreeing with that statement. That's significantly higher than average. Comparably, reviews are like 92% favorable, and the leadership gets an A rating. Their stated values, things like build community and democratizing design, seem genuinely embraced internally. Now, regarding capital allocation, Figma is aggressively reinvesting in R&D. Research and development spending spiked by something like 356% in 2024.
356%.
Yeah, huge jump. And this was significantly boosted by that $1 billion termination fee they got from Adobe.
Right, the breakup fee.
Exactly. It essentially acted as this non-dilutive war chest for innovation. They got paid $1 billion not to be acquired, and they immediately plowed it back into R&D.
That's quite a strategic move. But with all that heavy reinvestment, what does that mean for their return on invested capital, their ROIC? Is it any good?
Right now, their ROIC is actually negative, which, sounds bad, but it's pretty typical for a hypergrowth company making these huge upfront investments. When you're spending so much to capture market share and develop new products, it does temporarily hit profitability metrics like ROIC. However, and this is key, their exceptionally high gross profit margin, which is nearly 90%, shows the core underlying business is highly profitable once those investments start to scale and pay off.
Okay, so the potential is there.
Definitely. And the critical inflection point was achieving positive net income actual profit of $44.9 million in the first quarter of 2025. That signals future operating leverage and suggests a dramatic improvement in ROIC should be coming over time as these investments mature. And as you'd expect for a high-growth tech company like this, there are currently no dividends or share buybacks. Pretty much all capital is being funneled right back into the business for continued growth.
All right, so we've talked innovation, leadership, reinvestment. Now let's connect all of that to the bottom line. What do the actual numbers tell us about Figma's current financial health and its growth path? Let's get into Chapter 3, Financial Analysis.
Okay, let's break down the financials. First off, market capitalization. As of late August 2025, Figma's market cap was sitting around $34.26 billion. Now remember, it IPO'd at $33 per share, which implied about a $19.3 billion valuation at the time, and it even briefly soared way up near $70 billion post-IPO.
Wow, quite right already.
Definitely. That volatility alone tells you there's significant market optimism, but also some pretty intense reevaluation happening along the way. Now, for revenue growth, Figma has shown really remarkable and sustained expansion. We're talking the high 40% range year over year. For example, revenue grew 48% year over year in fiscal 2024, hitting $749 million. And then an impressive 46% year over year growth in Q1 of 2025, reaching $228 million for the quarter.
Those are seriously strong growth numbers, especially for a company reaching that kind of scale. But what about the profit margins? You mentioned that positive net income, but are they consistently making money yet, or is it still mostly gross at all costs?
Great question. When we look at profit margins, Figma boasts what you'd really call a best-in-class gross margin. It's consistently between 88% and 91%.
88 to 91% gross margin. That's huge for software.
It's incredibly high. It really speaks to the efficiency of delivering their core product. Now, operating in net margins, on a TTM basis that's trailing 12 months, they have been negative. And that's because of those massive reinvestments in R&D and growth we just discussed. However, that crucial turning point was the positive net income of $44.9 million in Q1 2025. That signals they're really starting to achieve operating leverage. Profitability seems to be genuinely on the horizon now, not just a distant goal. Free cash flow, or FCF, also tells that story of reinvestment. Remember the $1.04 billion FCF in FY23? That was mostly the Adobe breakup fee. Then it actually turned negative in FY24 to minus $63.7 million because they were investing so aggressively. But importantly, it returned to positive territory, $51.25 million positive, in the trailing 12 months ending Q1 2025.
Okay, so after using that Adobe windfall to fuel a ton of growth, they're now generating positive cash flow from operations again. That definitely sounds like a good sign for sustainability. What does all this mean for the company's financial stability overall, and crucially, its valuation today?
Financially, Figma looks very stable. Its debt-to-equity ratio is super low, just 0.05, practically no debt. And it holds a substantial net cash position of $1.48 billion. Plus, the current ratio is excellent at 3.52x, meaning they have plenty of assets to cover short-term liabilities. Valuation, though, that's where things get really interesting and maybe a bit controversial.
Oh.
Well, price to earnings, or PE, isn't really meaningful yet because profitability has been fluctuating so much with the investments. So the market tends to focus on the price to sales ratio, or PS, and Figma's PS ratio is approximately 41.7x on a trailing 12-month basis.
41.7 times sales. Wow. How does that compare to others?
It's a significant premium. Compare that to competitors like Adobe, which trades around 6.9x sales, or even Shopify at about 18.5x sales. It really highlights the extremely high market expectations baked into Figma's current stock price.
41 times sales.
Yeah.
Yeah, that definitely suggests the market expects, well, perfection, doesn't it? How do we try to figure out what it should be worth?
Exactly. It implies the market is pricing in near-perfect execution for years and years to come. It leaves very little margin for error if things don't go exactly to plan. To estimate intrinsic value, we often use a discounted cash flow model, a DCF. Basically, you forecast the company's future free cash flows way out into the future, and then you discount them back to their present value today. Now, for educational purposes, our DCF model suggests an intrinsic value range for Figma of roughly $45 to $60 per share.
$45 to $60.
Yes.
Compared to the current price around 70.
Right. Notably lower than the current market price of $70.28. And the key assumptions in that DCF model include still high but gradually decelerating revenue growth, eventually settling around 3–4% long term. We also assume their free cash flow margins expand significantly as they mature, maybe reaching 25–30%. And importantly, we use a higher discount rate, often called the WACC, or weighted average cost of capital. It's basically the return investors demand. We're using 9–11% here, which reflects the higher inherent risks of investing in a high-growth stock like Figma compared to a more mature company.
Okay, that's a lot to digest on the business itself and the numbers behind it. It really seems like an amazing company, but the market is clearly placing some very, very high expectations on its future. When we come back for part 2, we'll dive into how Wall Street and the media actually see Figma right now. We'll look at who owns a piece of this design giant, and critically, we'll outline the risks you need to be aware of. Stick around. Welcome back to the deep dive. We've just explored Figma's really impressive business model, its visionary founder-led management, and a financial picture showing incredible growth alongside that recent, crucial turn towards profitability. Now let's jump into Chapter 4. Market sentiment. Let's find out what the buzz is on Wall Street. How is the broader market perceiving Figma these days? What's the general feeling out there?
Well, the consensus rating among the analysts covering Figma there, about 9 to 13 of them, is actually hold, which is interesting, right? Not a strong buy. And their price targets reflect that caution. They show a really wide range, from a low of $48 predicted by Goldman Sachs up to a high of $85 from analysts at Piper Sandler and BofA. The average target comes out to $74.29.
So that average target is only slightly above the current share price. Not a ton of upside predicted by the analysts, on average.
Exactly. It suggests only pretty modest upside from where the stock is trading now, which kind of aligns with our own DCF model pointing towards a potentially lower intrinsic value. The media tone has also shifted noticeably. Initially, after the IPO, it was all blockbuster IPO, huge excitement. But now the narrative is leaning more towards lofty valuation, concerns about rising competition, and generally a more wary or cautious stance. It feels like that initial euphoria has definitely started to fade a bit.
Yeah, it sounds like the honeymoon period is officially over. Are there any technical indicators, maybe like short interest, that give us hints about this evolving market sentiment? Are people betting against it?
Yeah, short interest can be a useful gauge of bearish sentiment. As of mid-August 2025, the short interest was about 4.79 million shares. That represents roughly 2.39% of the available shares, the float. So it indicates a measurable group of traders betting the price will go down. And what's notable is that this figure represents a significant increase since July. So bearish sentiment seems to be growing among some market participants.
Okay, growing short interest definitely adds a layer of caution for potential bulls. What about simple price trends?
Well, technically speaking, the current price of around $70.28 is actually below its 50-day simple moving average, which is around $71.65. That's generally considered a short-term bearish signal by technical analysts. We don't have a 200-day moving average yet, simply because Figma hasn't been public for 200 trading days, so we can't really draw any long-term trend conclusions from moving averages just yet.
Got it. Okay, that growing short interest and the price dipping below that short-term average certainly paint a more cautious picture than maybe the initial IPO hype suggested. Moving on, let's explore who actually owns Figma, from the big institutional players to the insiders themselves. Let's look at Chapter 5, Ownership Structure. Right, so institutional ownership meaning large funds, pension funds, mutual funds, it's still pretty nascent, only about 0.54% shortly after the IPO. That's fairly typical for a newly public company. It takes time to get into the big indexes and portfolios. However, some notable early holders include ETFs like the ARK Next Generation Internet ETF and funds from JP Morgan and Vanguard. So some well-known names are getting involved early. Insider holdings, on the other hand, are substantial. Around 16.82% of the company is held by insiders, which generally suggests good alignment between management and shareholders. Their interests are linked.
16% is pretty high. That's usually seen as a positive sign, right?
It usually is, yes. But it's also important to note the significant volume of shares that were sold by insiders, including CEO Dylan Field himself. He sold about 2.35 million shares in other executives immediately after the IPO lockup period expired.
The insider selling. That always gets attention.
It does. Now, the company line is often that this is normal for liquidity founders and early employees finally cashing in some of their hard-earned equity after years of work. And there's truth to that.
Right.
But it can also be seen as a point of caution for new investors, especially when looking at a founder-led company trading at such a high valuation.
I mean, I hear normal for liquidity, but 2.35 million shares sold by the founder right after the IPO, even considering he still has massive control through the dual-class shares.
Yeah.
Doesn't that raise maybe more than just a point of caution for a new investor? How do people usually interpret that kind of move?
That's a really fair challenge, and you hit on the key tension. While some analysts and investors will absolutely see it as responsible diversification for a founder whose wealth is heavily concentrated in one stock, others definitely view it as a potential signal, especially when combined with that extremely high valuation we discussed. It can suggest that maybe even the insiders, the people who know the company best, might be taking some chips off the table because they perceive the current price as advantageous, perhaps even stretched.
It makes you scrutinize the company's future prospects and that valuation even more closely.
Exactly. It doesn't automatically mean disaster, but it adds weight to the cautious side of the argument. And this leads us nicely into ownership concentration. Figma is heavily founder-controlled. Dylan Field retains an estimated 74% of the total voting power through that dual-class share structure you mentioned. More voting power per share for him than for regular share owners.
74% control.
Wow. Yeah. And that's really a double-edged sword. On the one hand, it enables a strong long-term vision. He can execute his strategy without being swayed by short-term market pressures or activist investors. But on the other hand, it creates significant key person risk. The company's fate is incredibly dependent on one individual, his vision, his health, his decisions. If anything were to happen to him, it poses a major risk.
That makes perfect sense. Incredible potential for focused vision, but also a highly concentrated risk point.
Okay, now for maybe the most critical question in any deep dive. Let's break down Figma's strengths, weaknesses, opportunities, and threats. Let's tackle Chapter 6, Risk Assessment, starting with the SWOT. Okay, let's start with the strengths. Figma's greatest strength isn't just its market leadership. Although being embedded in 95% of Fortune 500 companies is obviously remarkable, I'd argue it's the almost impenetrable competitive moat they've built. Think about those network effects we talked about. Every new user makes the platform more valuable for everyone already there, and those high switching costs. Once an entire organization builds its workflow and design systems on Figma, it becomes incredibly difficult and painful for competitors to dislodge them.
That combination does sound formidable.
It really is. And that's backed up by those exceptional financials, 45% plus revenue growth, nearly 90% gross margins. Add visionary founder-led management and a strong balance sheet with $1.48 billion in net cash. It's a powerful combination. Now, for the weaknesses. The most glaring one has to be the extreme valuation. That price-to-sales ratio over 40x, it just leaves very, very little room for error. It demands near-perfect execution. This is compounded, psychologically at least, by that high insider selling post-IPO we just discussed. It can raise questions for potential investors. Plus, that founder control, while a strength for vision, absolutely creates that key person risk. And we've also seen quite a bit of post-IPO stock volatility, which indicates the market is still trying to figure out the right price.
Okay, valuation and key person risk stand out there. What about opportunities? Where can they grow from here?
There's still massive potential, I think. First, deepening enterprise penetration. They're in most large companies, but often only in pockets. The opportunity is to convert those smaller teams into larger, much more lucrative enterprise-wide deals, really expanding within existing accounts. Second, international monetization is a huge runway. Remember, 85% of their users are outside the US, but that only accounts for 53% of their revenue currently. There's a big gap there to close.
So converting international users into paying customers more effectively.
Precisely. And third, of course, is continued product expansion into adjacent markets. Think Figma sites, Figma slides, and especially those new AI-powered tools like Figma Make and Draw. These dramatically broaden Figma's total addressable market beyond core UI/UX design.
And the flip side, the threats.
Intensifying competition is definitely number one. You've got a highly motivated Adobe fighting back hard with its own suite. You have adjacent challengers like Canva constantly evolving and adding features. And then there's the potentially disruptive threat from new AI-native design tools that could, theoretically, automate large parts of the design process.
That AI threat feels like the big unknown.
It really is. Another major threat is simply valuation compression. High multiple growth stocks like Figma are very vulnerable to market downturns or shifts in investor sentiment away from growth towards value. The stock price could fall even if the business itself continues to perform well. And practically speaking, we can't forget the upcoming IPO lockup expiration dates. When those hit, more shares held by early investors and employees become available to sell in the open market, which could potentially create additional selling pressure on the stock price in the short term.
And beyond company-specific threats, we also need to consider those broader macroeconomic and maybe even geopolitical factors, right? How might those impact a software giant like Figma?
Absolutely. Macro risks are very real. Persistent inflation, for example, that could increase labor costs for Figma itself. But perhaps more importantly, it could lead their corporate customers to scrutinize their software budgets much more closely, potentially slowing down Figma's impressive growth rate if companies cut back. Rising interest rates also directly impact valuation models, especially for growth stocks. Higher rates generally mean future cash flows are discounted more heavily, putting downward pressure on the theoretical fair price of the stock.
Makes sense. What about geopolitical risks, like those U.S. tariffs from 2025 everyone's talking about?
Right. Well, Figma has no direct exposure to tariffs, obviously. It's a digital software company, not importing physical goods. However, there could be indirect impacts. Think about their major enterprise customers. If those customers are in sectors heavily affected by tariffs, say, electronics or automotive, they might be forced to cut their IT spending, which could trickle down to affect Figma's sales. There's also a potential, though maybe smaller, risk of rising costs if Figma relies on Chinese-origin cloud infrastructure, or perhaps software components from third-party plugins that become subject to tariffs or restrictions. It's more indirect, but still a possibility to consider.
Okay, so lots of moving parts on the risk side, too. Expert, let's try to pull this all together. What's the big picture here? Can you synthesize everything we've uncovered into the core bull and bear cases for Figma as we move into our final chapter, Chapter 7, Conclusion?
Sure. The bull case summary is, frankly, compelling. You're looking at arguably a generational, truly best-in-class software company. It has a dominant market position, protected by a deep and likely widening moat built on those strong network effects and high switching costs. It boasts visionary founder leadership, incredibly strong financials, think high growth, elite gross margins, and critically, that recent turn to profitability. Plus, there's still massive opportunities for expansion ahead, deeper into the enterprise, globally, and certainly with its new AI-powered product suite. The fundamental quality of the business is just exceptional.
Okay, that sounds pretty great. What's the counter-argument? The bear case.
The bear case summary, however, is almost entirely centered on that extreme valuation. A price-to-sales ratio north of 40x means the stock is priced for near perfection, leaving almost zero margin for error or disappointment. The insider selling post-IPO, while perhaps explainable, definitely adds fuel to the valuation concerns for bears. Competition is intensifying significantly, particularly from a revitalized Adobe and those potentially disruptive AI-native tools. And while founder control has its benefits for long-term vision, it undeniably comes with that key person risk concentration. So, for the bears, it's not really about questioning the quality of Figma's business. Most would agree it's excellent. It's almost entirely about the demanding price the market is currently asking you to pay for that quality.
Quality versus price. The eternal investment dilemma. Let's bring it all together specifically for you, our listener. Can you quickly recap the P valuation metrics we discussed?
Absolutely. So the current share price we're referencing is $70.28. The trailing 12-month price-to-sales ratio is sitting around 41.7x. Compare that again to a peer average closer to 6.9x. The average analyst price target is $74.29, suggesting only modest upside from here. And importantly, our educational DCF model generated an estimated intrinsic value range of roughly $45 to $60 per share.
Okay, so expert, distilling all of that, the amazing business, the risks, the sky-high valuation, what does this ultimately mean for you, our listener, whether you're just watching the tech space, using the tool, or actually thinking about investing?
Our concluding outlook is really this. Figma is, without a doubt, a phenomenal business. Top-tier product quality, incredible market penetration, strong financial profile. It truly is an exceptional company that has reshaped an entire industry. You can't argue with that. However, at its current share price, around $70.28, it trades at a significant, arguably steep premium to both its industry peers and our estimate of its intrinsic value based on current fundamentals and reasonable future projections. An investment at this specific level seems to demand near-perfect execution from the company for many years to come. It leaves very little margin for safety if they hit any bumps in the road, face stronger competition than expected, or if the overall market sentiment sours on high-growth stocks. It really boils down to that classic investment balance, weighing the exceptional quality of the business against the very demanding price the market is currently charging for it.
Figma has definitely redefined digital design once. But here's a final thought to chew on. If it continues its aggressive innovation, especially leaning into AI, could it potentially redefine the entire product development category into something far, far broader? Could that actually make today's valuation seem modest in hindsight years down the line? Or is it already facing potentially existential disruptive forces from those AI native tools that maybe even Figma itself can't fully control or adapt to quickly enough? Something to think about. This has been our deep dive into Sigma Inc. We really hope it gave you some valuable nuggets of knowledge and insight today. Remember, if you found this insightful, please do like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers they request. And exciting news over the next few months, we're planning to cover all of the S&P 500 stocks, and members will get exclusive priority access to those deep dives. And hey, if you just want a one-off deep dive on a specific stock that's on your mind, just drop us a super thanks on YouTube. Thank you so much for joining us on the deep dive. Until next time, keep digging.